I'm Chris Hostetler, and today we want to talk about a big question on investors' minds. What should we do about tariffs? This is a question we've heard a lot lately, and we want to address it while also talking a little about fear, how we handle it, and how we can benefit from it. If you've been following the financial news lately, you know that a feeling of anxiety has been dominating the markets. This month, various tariffs on Canadian, Mexican, European, and Chinese goods went into effect. In response, these countries imposed their own tariffs on U.S. goods, and now we're officially in a trade war. The markets have not reacted well to this news. As of mid-March, the NASDAQ is down almost 9%, and the S&P 500 is down almost 5% for the year. When fear strikes, it's natural to ask, are the markets going into a correction? Will the economy go into a recession? Should I change my allocation? Is it even time to get out and move everything to cash? These can be reasonable questions to consider, but they're not really the questions we should be asking. Of course, tariffs, especially at these levels, are not a small thing. While they can be used to generate revenue or bring countries to the negotiating table, they also can increase business expenses and cut into corporate profits. When this happens, many companies will pass these costs on to regular people like you and me in the form of higher prices. In other words, tariffs can be inflationary, at a time when we're still dealing with higher than normal inflation. Investors know all this. What investors don't know is how long these tariffs will last, how high they will go, or how big of an economic impact they will actually have. We don't know whether they will trigger a major downturn in the markets, and we can make reasonable assumptions and educated guesses, but we just don't know for sure. And that uncertainty, more than anything else, is why the markets have been so volatile lately. When fear grips the markets, many investors feel an intense urge to do something. As human beings, we always want to avoid the possibility of future pain. And since volatility can be painful, many investors start asking themselves, should I change what I'm doing? Should I get out of the markets completely? The thinking is that if they can somehow avoid the market turmoil, then they can get back in later when things are calm. It's like skipping the freeway and taking service streets until you're past the traffic jam. But there's a major problem with this thinking. Skipping the highway to avoid traffic is a short-term solution for a short-term problem. Investing, on the other hand, is for the long term. And one of the biggest mistakes in investing is making a short-term decision that has long-term consequences. Given that, here are the questions investors should really be asking themselves. If I get out of the market, how will I know when it's time to get back in? Would I rather miss a correction that could last a few months or a rebound that could last for years? If I own investments I like, would I really want to sell them and risk buying them back at a higher price later? To be clear, tariffs are an important story and one that will quite possibly be with us for a long time. And market volatility is painful, make no mistake about that. But when volatility strikes, no matter what the cause, we must always remember to focus on the long term and on what we can actually control, while not making a short-term move that could harm our long-term plan. If you're concerned about how all this economic news could affect your financial plan, now's the time to reach out to us. Learn more at our website, hilltopwealthadvisors.com.